Yeah. Good morning. We are going to talk about uh, consignment, consignment, accounting for consignment. Okay. Now, what is consignment? To consign is to send. In accounting, the term consignment account relates to it is the accounts of consignment is the dealings of the consignee and the consignor. Okay, how do they record the stock that is being consigned, that is sent, and how the amount is recorded by the consignor, the one who sends, and the consignee, the one who receives the goods. When these goods are sold, how it is accounted, how the commission is accounted, how the expenses are accounted, right? So to consign is to send. Okay, in accounting, the term consignment account relates to accounts dealing with a situation where one person sends goods to another person on the basis that the goods will be sold on behalf of the one who sends, okay, at the risk of the one who sends. At the risk of former means the one who sends those goods. Now, you should take into account, you should keep in mind these points. The party which sends the goods is called the principal or consignor. Consignor. The party to whom goods are sent is consignee or agent. The ownership of goods, that is the property in the goods, remains with the one who sends, that is consignor, the principal. The agent does not become the owner of the goods that are sent or received by him. On sale, whoever buys or purchases, that person becomes the owner, but not the consignee, the agent who sells the goods on behalf of the consignor. Okay, next, the principal does not send an invoice to the agent, but he sends a pro forma invoice. It's a statement which gives the details of the products or goods that are being sent. The object of the pro forma invoice is to convey what is the content but that is being sent. How many units are sent? What are the precautions to be taken? Okay. Now, in this pro forma invoice, what you see is, you will see the number of units sent and the value of the units. That is most important thing. Usually, the agent recovers all his expenses from the consignor, the one who sends. The one who sends is known as consignor. The one who receives is consignee. Again, I'm reiterating. The consignee, the one who receives, recovers all the expenses he incurs from the consignor, the one who sends. And this can be how much, what are the expenses, what is the commission that he has to receive, all that are as per the agreement. It is also, a practice to give an advance for the goods he is receiving. He has to deposit, the consignee has to deposit some money as advance with the consignor. Some money with the consignor. That's a practice. Okay, as a precautionary deposit. And once the consignee sells the goods of consignor on the behalf of consignor, all these expenses along with the deposit also is adjusted. For his work, the agent receives commission, as I told you, okay, on the basis of gross sale. And for ordinary commission, the agent is not responsible for any bad debt. What is bad debt? What is bad debt? Just, yesterday or so, I was listening to one interaction between Rao Gopal Rao and Sutti or somebody like that. Then this fellow goes on taking money and he never returns back, right? And he's used a word for the first time. I heard that word, chawu baki. Chawu baki means the baki doesn't come back. The loan that you advance will never come back. That's bad debt. That's bad debt. Okay, if the agent is to be made responsible for such bad debts, he expects extra commission. That's called del credit commission. That's called del credit commission. What is del credit commission? The extra commission to bear the risk of bad debts is del credit commission. It is calculated on the total sales, not merely on credit sales. Total sales. It is calculated on total sales, not on the credit sales. Unless there is an agreement says it is only on credit sales. If there's agreement which says it is calculated, should be calculated only on credit sales, then, as per the agreement you have to go. Otherwise, if the problem is silent, then you have to calculate on the total sales. Periodically, the agent sends to the principal a statement called account sales. It sets out the sales made by the agent, the expenses incurred on behalf of the principal, and the commission that he is supposed to receive from the consignor, and the balance due to balance payable by the consignee to the consignor. Okay, all these details are included in which document? Account sales. When it is sent periodically, maybe monthly, depending on their agreement. Every quarter they may send, every half yearly, or every year. Okay, next. Firms usually like to ascertain the profit or loss on each consignment or consignments to each agent. Consignment account relates to accounts dealing with such business where one person sends goods to another person on the basis of such goods will be sold on behalf of at the risk of the owner. Now, there may be a question. What is the difference between consignment and sale? Let's make the distinguishing point. Number one, in a consignment, the ownership of goods is with the consignor, but in a sale, the ownership is transferred to the one who receives the goods. Number two, in a consignment, the consignee can return the unsold goods, but in case of sale, goods once sold will not be taken back. Number three, in case of consignment, consignor bears the loss of the goods held by consignee, whereas the buyer bears all the risk and loss because he is possessing and he is the owner of that. Number four, in case of consignment, the relationship between the consignor and consignee is the principal and agent relationship, whereas the relationship between the in case of sale is seller and buyer, vendi vendor relationship. Or if there is no cash paid, creditor and debtor. If it's a credit sale, then it is a creditor and debtor relationship. Now, expenses done by the consignee to receive the goods and to keep it safely is borne by the consignor in case of consignment, but all expenses incurred by the buyer, it is his property, and he has to bear all the expenses. Valuation of stock. Valuation of stock, the closing stock. The principle is that stock should be valued at cost or at net realizable value, whichever is lower. Why I'm saying whichever is lower? It is under the principle of conservatism. What is that? What does that principle say? Conservatism principle says that anticipate all losses but don't anticipate gains. You anticipate losses, don't anticipate gains. Okay. Now, at the possible lowest value, you have to show when it comes to valuation, right? So therefore, whichever is lower is applied. The same principle as is practiced for preparing final accounts. In case of consignment, cost means not only the cost of the goods as such to the consignor, but all expenses are added, all expenses are considered till the goods reach the premises of the consignee. It is not just the value of the goods, it is all expenses till the goods reach the go down or warehouse of the consignee. All that are part of the cost. All that are part of the cost. Okay, next. What are those costs? Like you can include packaging, freight, cartage, insurance in transit, octroi, all the expenses incurred while bringing the stock goods from consignor to the consignee. But expenses incurred after the goods have reached the consignee's warehouse, whatever expenses are incurred are not treated as part of the cost of purchase for valuing the stock. Look at this. Why are we talking about these expenses? When we are talking about, when we are trying to value this stock, we had to know what is the cost of this stock. While estimating the cost of the stock, it is not just the price, it is all the expenses incurred by the consignor while sending those goods till they reach the godown or warehouse of the consignee. But once they reach the godown, all the expenses incurred are not part of the cost. When they're not part of the cost, and those things will not be counted or considered for valuation of the stock. Commission is the remuneration paid by the consignor to the consignee for the services rendered to the consignor for selling the goods consigned. Three types of commission, okay? Three types of commission. Ordinary commission, okay? The term commission simply denotes ordinary commission, right? It is given by the consignor regardless whether the consignee is making credit sales or not. This type of commission does not give any protection to the consignor from bad debts. Okay, if any non if there's a credit sale and if the amount is not collected, consignee is not responsible for that because he's receiving normal commission. Whereas del credit commission, I have already told you, for any bad debts, the consignor is not responsible. He has to make full account, he has to make full payment, and the risk is borne by the consignee if any event of default or bad debt. Overriding commission. Overriding commission. What is overriding commission? This is an extra commission allowed by the consignor to the consignee to promote sales at higher price than specified, to encourage the consignee, okay, to to push the sales, to put hard work in introducing new products in the market, and to enhance the sales volume. An extra commission is given. This is overriding commission, okay? and it is calculated on the total sales or on the difference between actual sales and the sales at invoice price or any specified price. Generally, if the problem is silent, calculate on the total sales. If the problem is specifying, okay, giving any clause, according to that clause, you have to calculate the overriding commission. Okay, account sale. Yeah, it's a periodical statement, right? Account sale is a periodical statement. What does it contain? Sales made, expenses incurred, and the commission earned. And the unsold stock or the leftover stock, any advance that is made or paid, okay, and balance due to be remitted. Okay, it's a summary of all his business dealing. The consignee business. Right. Generally, the consigner insists, this is what I told you already. Again, I'm repeating. Consigner insists the consignee for some advance payment for the goods consigned at the time of delivery. And this advance payment is adjusted in full against the amount due by the consignee on account of the goods sold. But if the advance money deposited by the consignee is in the form of a security against the goods consigned, then the full amount is not adjusted against the amount due by the consignee to the consignor on account of goods sold in case there is any unsold stock left with the consignee. In that case, proportionate security in respect of unsold goods is carried forward till the time of respective goods held with the consignee. Look at this in simple. If there is some unsold stock, okay, and this advance is not adjusted because there is already some stock unsold or left over. So for that reason, this may not be allowed to be adjusted. That's what he's trying to say. Now, let's look at a problem so that we understand what we have discussed so far. X sent on 1st July 2006 to Y. Goods casting, not casting, I'm sorry. Goods costing 50,000 and spent 1,000 on package. On 3rd July 2006, Y received the goods and sent his acceptance to X for rupees 30,000 payable in 3 months. Y spent 2,000 on freight and cartage, 500 on go down rent, and 300 on insurance. Okay. On December 2006, he sent his account sale along with the amount due to X, showing that 4/5 of the goods had been sold. What is that? 80% of the goods sold for 55,000. Y is entitled to commission of 10%. One of the customers turned insolvent and could not pay 600 due from him. Show the necessary ledger accounts. Show the necessary ledger accounts. This is a problem. Let's understand and try to analyze the problem. X sent goods. Who is X? Can you respond to me now? Yeah, this is a problem. Then we had to go slow. Okay, we have to understand bit by bit. X sent goods. Okay, who is X? You can unmute now and respond. Who is X?
Consigner, sir.
Consigner. Okay, X is consigner. To Y, who is Y? Consignee. Consignee. Okay, goods costing 50,000. Okay, what is this 50,000? This is the value of the material sent, and spent 1,000 on packaging. Okay, packaging. On 3rd July 2006, Y received goods Okay, why I received the goods. Okay, and send his the communication that I've received the goods. Okay, his acceptance to X for 30,000 payable in 3 months. 30,000 payable in 3 months. Now, what is this 30,000
Advance.
advance? Why spend 2,000 on freight? These are all wise expenses. Wise expenses. Now, he sent an account sale. 4/5 means 80%. Okay. And goods are sold for 55,000. 80% of the stock is sold for 55,000. Okay. 55,000. Right. And why is entitled to a commission of 10%? 10% on sales. One of the customers turned insolvent and could not pay 600 due from him. Show the necessary ledger accounts. Yeah, these are the ledger accounts. Consignment account or consignment to wise account. Consignment to wise account. Okay. On on July 1st, consignment account debit, yeah, here it should be debit, ma. Debit to goods sent on consignment. Goods sent on consignment, 50,000. Again, consignment account debit to expenses or bank to bank in bracket expenses, 1,000. Okay, to bank, 1,000. Okay, next. Yeah. To Y. Y also has spent expenses, right? Y also spent expenses. What are the expenses of Y? Look at the Y's expenses. 2,000 on freight and cartage, 500 on go down, 2,500 and 300 on insurance. Okay. Okay. And anything else? Anything else? Yeah. 2,500, 2,800. Yeah. 2,800 and what is bad debt? How much? 600. 2,800 plus 600, 3,400 is the, amount incurred and loss on bad debt is 600 plus amount of expenses incurred 2,800. Okay, so total amount is 3,400. Yeah, please mute yourself, ma. There's a noise. Yeah, there's a noise, please. All right. There's right. So this is the problem, and these are the expenses. Yeah, why spent 2,000 plus 500, 2,500 plus 300, 2,800. And in addition to that, there's a bad debt of 600. Okay, there's a bad debt of 600. Yes, this is 600, right? All put together is 3,400. And there is a commission. Commission is paid on the sales, right? What is the sales value? Commission is paid on the sales. So on sales of or sales value of 55,000, 10% is paid. 10% is paid. Okay, 10% is paid. 5,500. 5,500. Okay, consignment account debit to profit. I'm sorry, commission, wise commission. right? 5,500. Okay. Next, what else? Yeah. Now sales, buy sales, buy sales. Who sales? Y sale. Y sold the goods, na? Buy Y sales, 55,000. You should write not buy sales, but buy consignee sales, because it is the consignee who sells the goods. Buy consignee sales, 55,000. Okay, 55,000. And buy closing stock. Buy closing stock. Stock on consignment. Okay, buy stock on consignment. What is that? That is closing stock. That is closing stock. Yeah. Right. How do you get this closing stock? How do you get this closing stock? Anybody? How do you get this closing stock? Yes. Our problem, uh, the goods center 50,000, the expenses, corresponding expenses incurred 1,000. So 50,000 plus 1,000. 51,000 is the total worth of the goods sent. Now, as per the previous, as per the this, as per the instruction, what is the instruction? Unsold stock left with the consignee. Okay, not unsold stock. Yeah, this one. Yeah, no. Stock. Yeah, stock valuation of the stock. Right, the stock or the cost of the goods to the consignor. Okay, goods to the consignor means including all expenses incurred till the goods are reached to the consignee, such are this. Okay, now when we come back to the problem, 50,000 and 1,000 spent by X to send the goods to Y's go down. Okay, to Y's go down. 51,000 is the cost. Now we have decided the cost. Now what is the closing stock? Value of the closing stock? Value of the closing stock is what is the amount sold? Look at the amount sold. Value of the 4/5. 4/5 of the stock is sold. Means 1/5 is unsold. Means 20%. 20% is not sold. So therefore, let's say 2,000. 2,000. This is 2,000. 2,000 on octroi. Okay. So when you add 1,000 plus 2,000, 3,000 plus 50,000, 50,000, 53,000 into 20% gives you this 10,000. 50 gives you this 10,600. Okay. So the first item on consignment is goods sent on consignment. Then all expenses of the consignor. Okay. Then you will come to all expenses of consignee and the commission of consignee, all types of commission, whatever is the commission. These are the debit items. Okay. The debit items are goods sent on consignment, first item. Okay, expenses of the consignor, second item, expenses of the consignee, third item, commission of consignee. Okay, now if you look at the credit side, Sale, why sales? That's consignee sales, first item. Second item, stock, leftover stock. Okay. Now, if you take the balancing, the amount transferred to the profit and loss account is 5,700. This is the profit on consignment. This is the profit on consignment. Okay, this is one account. Now, goods sent on consignment. One more account that we had to prepare is goods sent on consignment. Whatever is credited here, look at this. How many accounts are there? There's one account. Okay, that's goods sent on consignment account, expenses account, okay, sales account, why sales account, and consign. These are all accounts only. Okay, commission, expenses of consignee, consigner, expenses accounts only. So we will prepare the respective accounts. What is debited in consignment account will be credited here. So goods sent on consignment account. Okay, it is debited to consignment account. It is credited to, okay, it is credited to goods sent on consignment account. Look at this one. I'm just trying to say this. Yeah, 50,000 is debited in consignment account, whereas in goods sent on consignment, it is credited. Okay, what was written here is written here, right? And the balancing figure is 50,000. There's no balance on the debit side. It is 50,000 transferred to trading account. Next is stock account. Okay, stock on consignment account, right? So 10,600 is the closing stock. Okay, this closing stock is debited to consignment account, and there's nothing on uh, credit side. That's a balancing figure. Okay, balancing. Is anybody calling from you? Nobody? Yeah, right. So wise account, this is consignee's account. Consignee's account, where all you have debited. Look at this. If you look at this, yeah, where all you see y, you see y here. Okay, y here. Wherever you see y, this is credited. Okay, in y's account you will debit. Here also you see y. Okay, here also you see y. Okay, y, and y. If it is credited here, you debit there. If it is debited here, you credit there in Y's account. Come back to Y's account. Look at this. Y's account. Right. To consignment account. Look at this. It was credited, if you remember. It was credited. Look at this. It was credited in consignment account. 55,000. Okay. Now, when you come back to Y's account, it is debited. Y's account to consignment account, 55,000. And similarly, all expenses. Yeah, look at this. He has spent expenses, and including bad debts, 3,400. Okay, and uh, he has also made some. He has also made some. Uh, yeah, he has also made some. Yeah. Yeah, deposit. Yeah, here it is. He has also made some deposit, 30,000. So this 30,000 we will bring and drop here. Okay, by consignment to Y's account, 30,000. Okay, it is credited in consignee's account. Okay, consignee's account. And in addition to his deposit and the expenses, whatever commission he is due to receive, that is also charged here, right? So the balance is, the balancing figure is 16,100. 16,100. This is the 16,000. This 16,100 is to be remitted to the consignor. Look at this one. This is the amount got from sales. You received from sales. Okay, why received from sales? Then he deducted his deposit of 30,000, his expenses of 3,400, and his commission of 5,500. Leftover amount 16,100 is to be returned to the consignor. Okay, so there you're writing by bank. Why you're writing by bank? All these accounts are prepared in your books, the consignor's books. That is why you're writing here by bank. Okay, 16,100 is due to be received by the consignor. That's it. End of the solution. Please ask me the doubts if you have any now. Yeah, problems, unless